Now you could be excused for thinking the title of this video is some savage clickbait. I mean, I have got priors. But in a week where we've learned that Matt Hancock is getting paid 400k just to go into a jungle, I think we should accept that anything's possible. The longest recession since records began. That's what's being forecasted for the UK. And the headlines, well, they're eating it up. Another headline that is making the rounds is the fact that we just cranked interest rates up by 0.75% or 75 basis points. Now, we can all be guilty of just skimming headlines sometimes and making an assessment of something without actually going into proper detail, but I think it's worth going into detail with this topic. It's called the Monetary Policy Report, and today I'm just going to make a really quick video going over what it's saying about the state of the economy going forwards. It's a really big report with loads of detail, so I'm just going to pick out some key points and not go over everything. I'm trying to focus here on the big points that affect individuals. I'm sorry, we're going to be light on jokes today because I want to react to this quickly and get this video out, and it takes me time to figure out how to be funny. As well as that, I feel really rough at the minute. Turns out that delaying putting your heating on has some unforeseen consequences. If only I could get paid to sit in a warm jungle all winter. Anton Deck, I'm here ready for you when you need me. But let's start with this slide, which is the Bank of England's forecast for inflation. So they think that the rate of inflation is peaking around now and will likely see a spike in the next couple of months, hitting about the 11 to 12% mark. And then, as you can see, they expect it to fall off really dramatically, back down to their target of 2%. On screen now are the actual forecasts in terms of numbers for inflation. I'll leave these on for a minute so you can have a look at them. I imagine a lot of this prediction coming true is reliant on energy prices stabilising. I really hope this works out because we all need some relief when it comes to energy. But I don't know how they're forecasting this with any form of certainty, especially if they're reliant on a resolution of the Russia-Ukraine conflict at the minute. Because, I mean, looking at that from an outsider perspective, I know very little about the actual conflict itself beyond what we see on the news. But it seems like no one knows when that's going to end. But yeah, they seem certain that we're approaching the end of inflation, or the worst of it, I should say, and that we're going to see it to start to come down quite dramatically soon. We'll be able to hold them to that prediction, won't we? The next slides are the more interesting ones, I would say. I mean, this one here is dire. What you're looking at is a forecast for GDP growth. Remember that GDP stands for Gross Domestic Product and is just a collection of the value of all the stuff a country does and makes in a year. Now, if we see that number, that GDP figure, go backwards, so a minus figure, for 2 quarters or 6 months, that's a technical recession. That's when we've entered a recession. And remember, a recession, we always look back at it. So we always need to look back at the last 6 months and go, oh, we had 2 quarters of negative GDP growth. That means the last 6 months were a recession. This chart is a forecast of the GDP growth going forwards. It's called a fan chart. That's why it spreads out like this. And reading the Monetary Policy Report, it says, if economic circumstances identical to today would prevail on 100 occasions, the MPC's best collective judgment is that the mature estimate of GDP growth would lie in the darkest central band on only 30 occasions. That's this section right here. So they're basically saying if we rolled the dice 100 times, we think that 30 times we would end up in this dark blue band here. Now, that forecast means one of the longest recessions ever on record, something like a 2-year recession, which is an absolute beast. And that's the headline right there, guys, the longest recession since records began. A quick Google search will tell you that the average recession lasts about 10 months. That's an example right there, me just skimming the headlines. But yeah, they're saying that this is going to be a long recession potentially, but it's also worth noting that they've also said that they don't think it's going to be a very deep recession. This slide does a good job of demonstrating what I mean. You can see here that the depth at which the GDP fell in other recessions, so the severity of those recessions. They are forecasting this one to be long and shallow by comparison to the others. That is a forecast, of course, so anything could happen, and if you go through previous reports, they've often been wrong with forecasts on other things like GDP growth, etc. But yeah, these numbers here spell out what they think will happen. They're saying in the report that GDP, so the total value of all the stuff in the UK, will fall by 1.5% in 2023 and 1% in 2024. Just to give you a comparison, the recession we saw in 2008, which is one of the big boy recessions we've seen in this country, GDP fell by 2.6% in 3 months. They're forecasting here that the GDP fall over a 2-year period will be less than that. Not all recessions are the same. It is a scary word, but they are different in their impact, severity and length. Now, one thing they all do share in common though brings us onto our next slide, unemployment. Raising unemployment rates are a signature of recessions as businesses lay off staff to cope with decreasing demand. It can be a self-fulfilling prophecy in a way. So me and you sit here talking about recessions and we all panic and start cutting back just in case one happens. And because we're cutting back, we're spending less, so businesses make less money, and then they need to sack staff in order to cope with the fact that they earn less cash. More people get sacked, so spend less money, and then you get a recession because people are worried about a recession. This cutback is already happening according to the report. There are comments here stating that supermarkets are observing a shift to cheaper alternatives and that budget supermarkets like Aldi and Lidl are increasing their market share. We can clearly see on this slide that they're forecasting unemployment to raise to a worst case scenario of 9%, but their best guess is 6 to 6.5%. A good way of visualising this is if you took 30 people and put them in a room, one of them at the minute would be unemployed. If we went to 6.5% or 6% unemployment, then 2 of those people would not have a job. So 2 in every 30 working people in a room would be unemployed as a result. That would be around an extra 1 million people losing their job. I've said it before and I'll say it again, that is the biggest threat that a recession poses to your personal finances. It isn't your decrease in stonks or your house price dropping, it's the loss of income, the risk of losing your job. I just implore you to really look at your emergency budget and just make sure you have a robust one that could see you through a period of unemployment just in case that happened. The damage you can do to your finances can be catastrophic, even in a short amount of time, if you're not set up to weather a short-term storm. And an interest-free credit card isn't an emergency fund. The goalposts can move on those quite quickly. You want, easy access cash that you can get your hands on in case the worst was to happen. The key here is not needing to sell your assets at a time when they're depressed in value. We want to be buying assets at a discount, not selling them. I know it's boring, basic advice that's hammered home, but really it's those basics that will save you if the worst was to happen. Right, now let's talk about mortgages. Here, they're pinning the rates for a 90% and 75% loan-to-value mortgage. Another interesting slide is this one, which shows that 2 million people will be coming off fixed-rate deals by the end of 2023. It's hard to see how in the face of data like that house prices won't fall. But, the housing market in this country has an uncanny way of just keeping on trucking. But the Bank of England does talk about the softening housing market. I'll show you a slide now. Along with this slide, they said that indicators such as Halifax, Nationwide and Rightmove data show that UK house price growth has started to slow. Contacts of the bank's agents expect that to continue, reflecting reduced affordability as a result of materially higher mortgage rates. Mortgages are more expensive, people can afford less on a monthly basis, that means house prices come down to match that. I think everything I've discussed so far really won't come as a surprise to people. I mean, this chart right here, demonstrating consumer confidence, highlights just how pessimistic we all feel about things at the moment. This itself is a recession indicator, as when people feel less confident, they spend less and we get that cycle that we talked about a minute ago. I've just tried to cherry pick the main points out of the report there that I think are most appropriate to people watching, but there's loads of interesting detail in there and nice graphs to look at that kind of spell out and confirm everything that we think is going on at the minute. Like I said, I'll leave the full report below for you so you can have a read of it if you like. Even if you don't read it, just scroll through and have a look at the graphs, you'll get a lot of insight from those. I now want to talk about an interesting dynamic that is developing between the UK and the USA currently. When people describe the tone of a central bank, they often talk about them either being hawkish or dovish. Financial markets love an animal comparison, don't they? I mean, you've got your bears and your bulls and your hawks and your doves. In its simplest form, a central bank that is hawkish is wary of inflation and warning of interest rate rises to combat this, whereas a dovish approach is more worried about deflation and the potential for decreases in interest rates. Now, they sit at opposite ends of the scale, but it is a scale. You can still have a central bank that's raising interest rates that could also be described as having a dovish tone. I'm speaking about this because the tone of the Fed in America is definitely on the hawkish side at the minute, but the UK is seen to be more dovish. First of all, Andrew Bailey points out in this clip that they are very different economies, and at this point they're facing very different pressures, so it's to be expected that we have a different policy and tone around that policy.
I don't think people would be surprised when they see that we and the Fed are looking at things through slightly different lenses and we come to different conclusions.
But it's still really interesting to observe this tone. You've got the Fed who are coming out very hawkish saying, we will do whatever it takes to get inflation under control. And then you've got the Bank of England saying instead this. Further increases in bank rates may be required for a sustainable return to our inflation target, albeit to a peak lower than priced in by financial markets. They're basically saying they think the markets are over-egging the interest rate that will be required to bring inflation down to the 2% target. Now, they are different countries, so there's going to be different approaches, and we do have different pressures here in the UK because, we're more exposed to the European energy crisis. But I do think it's really interesting that two similar sorts of situations can have different tones around them and potentially different responses. It's just a reminder that there is no surefire playbook on how to get out of this mess. This is a monetary policy experiment in real time, as they call it. And what we're seeing is the opinions and thoughts of people in charge on what the best way to navigate this is, which kind of brings me on to my next point. There was a really interesting interview yesterday with a guy called Bluntsflower on LBC. And to say he isn't a fan of what the Bank of England are doing is an understatement.
Well, I think it's absolute madness.
He's a former member of the MPC, so the people who are making this report we're discussing. And in 2008, when he was a member of the MPC, he came out and said that we should be dropping interest rates when everyone else disagreed. He was proven to be right. So he has a track record of working in this environment at a time similar to this in a sense of, economic turmoil and making a prediction or the correct call in terms of which direction we should go. So, like I said, he is credible. His argument is quite simply that the Bank of England are making the wrong decisions.
We're already in recession.
He says that something called the Purchasing Managers' Indices shows we're already in a recession. So raising interest rates while we're in a recession will lead to us having
The worst recession since 1929 or so.
Instead of raising interest rates, he thinks we should be
That you should be cutting rates. You're heading into a recession. Mortgage prices have risen up. People can't pay their bills. Unemployment is set to rise. And firms are going to close and people's spending is going to collapse because the consumer confidence is on the floor.
He thinks that the narrative around inflation is misguided and that what's causing inflation are shocks to the system. You know, the energy crisis and COVID. And those are short-term temporary shocks that will come down quickly. They're like one-off price movements effectively into the system, not, you know, embedded inflation over a period of time. But the report disagrees with him. This table is a visual example showing that yes, energy is a large part of inflation, but the report also makes comment that certain domestic factors are also pushing inflation up in the UK. But Danny clearly disagrees and thinks
So I wouldn't trust them a bit. And what you're going to see is this is going to tank the British economy. Unemployment's going to rise like mad.
Well, they
and
said
things
it
are going to
will.
look really bad. And they're going to start to reverse turn on this very quickly in the new year.
a reverse in the new year will be quite something, and we really don't have long to wait to see what will happen with this prediction, do we? But before then, it's going to be all eyes on the 17th of November, because Danny points out,
if the Chancellor goes and does austerity, if that happens, then at the next meeting, the Bank of England will have to cut.
you can hear the passion in his voice, can't you? He really thinks that the Bank of England are just kicking people while they're down. If we get cuts in terms of public spending and austerity, he feels the collapse in the UK economy could be dramatic and inflation will come down rapidly, meaning the Bank of England will have to reverse the rate rises. Which on paper might sound great, yay, cheap mortgages and all that, but it would be in response to a dire outlook for the UK economy. No one pops a sudden U-turn in the road when things are going the right way, do they? Who is right? I don't know. I'm no central banker or expert on these matters. All I'm doing is collating the opinions of the people that do claim to be experts and presenting them to you. All I know is that the people at the top are making decisions on which direction to steer this little island of ours in, and we don't have any control over which way that's going. All we can do is ensure that we're prepared and on a good financial footing. Recessions often present opportunities to those people who are in a stable financial position because they can pick up assets at a cheaper price. So just try and prepare yourself for that. Look, I'm sorry that the overall tone of this video has been pretty down, not helped by me having a cold, clearly. But yeah, if you watch my content on a regular basis, I normally like to end with a bit of a joke and like a big beat and all of that, but I just don't really think that's appropriate today. So all I'm going to say is, I hope in the face of what is a pretty bleak outlook for the UK in the short to medium term, you don't let that, get in the way of you just living your life and it doesn't bother you too much. I understand people are in all different kind of financial circumstances, and for a lot of people, the situation at the minute is quite dire. It's not just money, it's, life or death for some people. Again, I hope that doesn't apply to you, and I hope you can, put this to one side and kind of just enjoy your weekend and remember the other things in life that matter. For me personally, I'm going to a Day of the Dead festival tonight with my family to watch some fireworks. Then I'm going to spend Saturday with my cat, Cobweb, playing Red Dead Redemption 2. And then I'm going to watch the Fred Again interview with Zane Lowe. I mean, Zane Lowe chats a load of rubbish, but I like that Fred Again. His Boiler Room session was amazing. So yeah, I'm going to watch that. Love to know what you guys are up to in the comments. So yeah, drop me a comment below. Let me know what you're getting up to this weekend. Thank you.